Hey everyone, Mark here. Today I want to break down some key concepts around options trading and backtesting, specifically how we identify and maximize edge in the market. So in this video, we'll cover what edge means, how we capture it and protect against risk, how expected value shapes our strategy, and by how increasing trade occurrences smooths out our returns over time. Real-world backtests to prove how these principles work, and of course, we'll also cover something most traders overlook: the hidden impacts of slippage and fees on your bottom line and profit. Let's get started. Okay, I wanted to intro some concepts here around edge and risk premium. So the simplest way I can define edge is that you're able to find a more accurate price from the marketplace, and that you're able to withhold that edge and create enough occurrences to protect against risk to realize it. The other half of edge is oftentimes there could just be whatever price the marketplace is quoted. And because that carries risk premium, by holding on to that, you can realize a positive P&L or be compensated for holding that risk. When we think of this, we need to look at the trade-off between them. And I think there's about 4 components that come into this, which will be accurate price. It will be, does it hold risk premium? Then it's, can you create enough occurrences? And the 4th one would be, can you protect against risk so you will not blow up? An example that I often see with this are kind of Twitter's 2 favorite strategies, and I wanted to compare both of them. The first one would be a Martingale strategy, aka buying the dip. And basically what that looks like is, in Martingale, we'll go through the 4 components of edge, which would just be continuing to double down your size as we go through more and more risk coming on board. So does Martingale have? Yes, 100%. As we go through the components is, do we have a more accurate price in the marketplace? Definitely not, because the price went down. Maybe now when we're doubling down, we potentially get a new price that is more accurate than the marketplace. Does this have risk premium? 1000%. And assets that's falling will basically spike the volatility of it, and we will be compensated more to potentially hold that. Are we able to increase our occurrences while we do this? 100%, because as it goes down, we're able to buy more and further lower our price potentially. And then can we protect against risk with this? Absolutely not. Our only risk is doubling down. And the problem is it gets increasingly more stressful. And also we will eventually run out of capital potentially before, the price rebounds. The other strategy that is very popular there on Twitter is a buy low, sell high, otherwise known as HODL, or hold on for dear life. Basically, this does have edge because whatever asset we're buying, we're planning on selling it at a higher price sometime in the future. So in regards to this definitely does have edge. Do we have a more accurate price in the marketplace? 100%, because we can't lose money. We're going to sell it for a higher price than we bought it. Does risk premium exist in this? 100%, because the risk premium is we could have our money in another asset because we don't know how long it will take for the price to rebound, and that could be yielding a return as well. And then can we create enough occurrences to do this? Absolutely not. We can't create enough occurrences because we're not in control of basically how long it will take for the price to go up, and we just have to take whatever the price is. And can we protect against risk? We absolutely can protect against risk here because, again, our plan is to only sell when the price is higher. Therefore, we cannot lose money. The huge problem with this, though, is the time frame. So we have no idea how long it will take to get to that new all-time high. If you bought Cisco in 2000, you're still waiting for that to happen 25 years later. I wanted to compare this to an option-based strategy and how we can use the exact same concepts to basically evaluate a different way of using the 4 concepts of edge and apply it to options. So the first thing would be kind of like a quasi martingale strategy. And what we would basically do is we would sell a 10 delta strangle daily at 7 days expiration, no filters, no management, just letting it go. So does this have edge? I would say 100%, because we're able to form a more accurate price in the marketplace. A 10 delta strangle on each side should expire in the money roughly 20% of the time. You can see here that it has an 85% win rate. So that means we have a more accurate price in the marketplace. The next, does this have risk premium? We can exactly say that because there's a huge amount of risk with holding naked options, and we could see for every dollar we sell, we retain 30 cents of that with premium capture. Can we make a lot of occurrences with this? 100% absolutely, because each day we're selling it and there's no management, and the benefit of that is it's repriced each day for whatever is happening, so we can do that. And then can we protect against risk for long enough to realize that edge? Absolutely not. We cannot trade this at really any size larger than 1 or 2 times notional because the size would just eventually eat us if something were to go against us. So that is basically the problem that we got. So we're able to have an accurate price. We know that there's risk premium in the marketplace. We're able to create a bunch of occurrences, and the variable that we are missing is basically protecting against risk. So how would we solve for this with an option strategy to try to create an edge with the 4 parts of the equation? The first part would be we could choose to buy wings. So we'll try to buy 1 delta wings here to basically trade a condor. So when you see this is the cost of those wings almost eat up all of our expected value. And again, this makes sense if these short options have risk premium or an inaccurate price. The out of the money options, would probably be more overpriced because they're further out of the money and can contain more skew. And we would be going against our whole thesis, which is volatility, risk premium, volatility is overstated, it has edge, and now we're buying. However, we could have another option where we buy a long straddle now. So we're going to buy 2 50 delta options of money. And there's several benefits to here. So you could see that there may not be edge in this, but it seems as there's an accurate price because it's basically break even over a period of time. The other thing this does for us is we can now offset any potential buying power that we have to incur on this trade because we have our long options before our short options. And some people will say, hey, why does this work? And the way to think of it now is when we're looking at more accurate price in the marketplace or more edge, this adds to it because the at the money option is the most accurate predictor of future price movements. And if you hold up an option chain, you can see this. The at the money option may be an 18% volatility. And then as we go further out of the money, what is also known as skew is those options, especially on the put side, at a 10 delta put, may have an implied volatility at that strike of 24%. So we're basically buying an 18% vol and we're selling a 24% vol. So you could see now, if we go back to the equation, is do we have a more accurate price than the marketplace? Yes, we got an even more accurate price because we're essentially, arbitraging the skew between the accurately priced at the money option and the more overstated volatility of the out of the money option. And are we able to basically have risk premium in this? Yes, because we are selling more of the expensive option with the out of the money option than we are buying with the at the money option. Are we able to create a lot of occurrences with this? Yes, 100%. We can do it every day and it's more capital efficient, so we can turn it over even more. And then are we able to protect against our risk? Yes, 100%, because if our long option is in front of our short option, if the market goes down 20%, we're going to basically realize that entire edge between the 50 delta option and the 10 delta option when that completely goes down.
So to wrap this up, start with edge. Accurately price your options better than the market and be able to protect against the risk to realize that. Use the expected value equation to structure profitable trades and increase your occurrences and use multiple strategies to smooth out your returns. Always factor in slippage and fees. Don't let your execution cost you and surprise you. Now let me know in the comments what your biggest challenge is that you're finding in trading to find these edge. If you found this video helpful, like, subscribe, and hit the bell so you don't miss another deep dive. Thank you for watching, and we'll see you on the next one.